One of the most overlooked parts of the BRRRR method is the refinance step. People seem to think that they can just go to one bank, go with whatever terms the bank gives them because all banks are the same, and that could not be further from the truth. So in this video, step 4 of the BRRRR method, I am going to break down the refinance method. I'm going to talk about understanding truly what it is, talk about different types of funding sources you can go to, and most importantly, I'm going to give you some tips on how to maximize the refinance by getting the highest appraisal possible, because yes, somebody else is going to value your property and you can bump that appraisal value up, as well as get the best long-term rates possible. If you're able to maximize your appraisal, you're going to have more equity you can pull out, so you're not using any of your own money. And if you're able to get the lowest terms and best rates possible, you're able to cash flow as much as possible. So this is like dotting the T and crossing the I. Reverse that. Of the BRRRR method, this is an extremely important part, and you're going to want to dig in and take notes so that you can finish this BRRRR method with a bang. All right, let's quickly cover why you're even getting a long-term loan. Well, you're getting a long-term loan because you need to finance the vast majority of this property that you're buying with the BRRRR method over as long time as possible, so the payment is as low as possible, so that when you collect rent, you pay the mortgage, your cost to borrow the money, plus all your owning expenses, and there is cash left over, just like I covered in video 1 of this series. Your initial funding you're getting from private lenders and hard money lenders is short-term loans. Private money lenders and hard money lenders do not want to lend you the property over 6 months, maybe a year, and their interest rates tend to be like that 8 to 15%. So if you want to get lower interest over 20, 25, 30 years, your monthly payment is going to be much lower. Therefore, you're going to be able to cash flow and own this thing truly with no money out of pocket. So that's the power of this refinance step. There are 2 main places you're going to want to go to get this long-term financing. One of them is going to be local banks, and another one is going to be DSCR lenders. Let me explain the difference in the two and why they even are both an option. So small local banks were the option for the longest time. That's all I knew. I started investing in real estate in 2014, and from 2014 to 2021-ish, every single long-term loan I did, whether it was on a self-storage facility, a single-family rental, hundreds of them, or an apartment complex, it was all done with small local banks. That's because the Fed's funds rate, which I'll explain exactly how that is calculated versus a normal type of loan in a minute here, but that Fed's funds rate was historically low. That's why banks could lend at such a low percentage. So for example, after COVID, the Fed's funds rate was around 0, which meant the banks, these small local banks, could upcharge what they borrow the money from the government at. That's the Fed's funds rate, the federal funding rate. These small local banks, they borrow money from the government. They were borrowing it at 0% and then lending to me at 3 or 4%. And everybody was happy because we cash flowed. Government was giving away free money pretty much, but guess what? I was cash flowing, the bank was making money. After 21 into 2022, the Fed had an historic rise as far as speed goes in the Fed's funds rate. It's been higher before, but it went from 0 to about 5.5% in a couple years, which meant banks borrowed money from the government at 5.5%. That's why they were lending it out to me and other investors at 8, 8.5, 9%. Cash flow does not happen if I'm borrowing money over a long period of time at 9%. It barely freaking happens when you're borrowing it at 3 or 4%. So that created a huge gap in the market, and that's where these DSCR lenders came into play. DSCR stands for Debt Service Coverage Ratio, and it's an asset-based lending formula that utilizes alternative funding sources over long-term periods of time. So for example, I'm able to right now get a 6 or 7% loan over 30 years. So if I'm financing $200,000 at 6% over 30 years, my monthly payment is going to be hundreds of dollars a month cheaper than if I were borrowing $200,000 at 7 or 8% from the small local banks over 20 or 25 years. Plus, the rates are variable. If you go to a small local bank in 3 to 5 years from now, the rates are going to adjust based on the market. That could mean they come down, that could mean they go up. It's just a little bit of an unknown. When you go with this DSCR lender, you're getting fixed rates over 30 years that are right now cheaper than small local banks. That will change as the Fed's funds rate goes down, but that's not happening as quickly as most people like. So you kind of have 2 options right now, and the DSCR option was born out of the necessity because small local banks loans got a lot less appetizing. DSCR lenders and loans had been around for a while, but they couldn't compete with small local banks. As soon as small local banks felt the wrath of the Fed's funds rate being so high, they tightened their belts, and DSCR lenders really made a big comeback. In fact, I have my own DSCR lending company now called FasterFreedom Capital, but just know I can help finance your stuff at really low rates because I don't mark up the rates. I get them from a funding source, a fund, and a family office, and I don't mark up the rates, so you get really good rates, the best in the country over 30 years. So check out that if you're ever looking for a refinance. Here's a quick interest rate lesson. This is maybe just for trivia, but I think it's good for you to know. The Fed's funds rate and the 30-year rate you get on residential properties, we're talking if you're going to buy your personal house, that 30-year mortgage rate you get and the Fed's funds rate are completely separate. Most people think they are linked. Most people think when Jerome Powell, the head of the Fed, raises the Fed's funds rate, that means that the 30-year mortgage rate goes up. That's not accurate at all. There is some linkage between the two, but they are not directly correlated. The 30-year mortgage on residential properties is based off the 10-year Treasury note, overnight rates, as well as market cushion or market profit built in. The Fed's funds rate is just what Jerome Powell and the Fed says it is. They can be linked, but over the past year, the 30-year mortgage has actually gone down, and up until recently, the Fed's funds rate pretty much remained the same. The 30-year mortgage is backed by the government via Fannie Mae and Freddie Mac. Every single loan that goes through a traditional 30-year mortgage on your personal house gets sold on the secondary market to Fannie Mae and Freddie Mac, and the market builds in some profit. They underwrite the loan to you at 7.5%, and then they package it and sell it to Fannie Mae or Freddie Mac at 7.8, 7.9%, and they make a little bit of spread and move on to the next one. The Fed's funds rate is for commercial loans at small local banks, and the banks hold those notes in-house. They can have a little bit of correlation because depending on what the Fed's funds rate do affects the market over here, but they're not directly affected tit for tat. This goes up, this goes up, this goes down, this goes down. It doesn't work like that. All right, back to the refinance. I just wanted to give you a little bit of better understanding of how rates are actually determined. The quick pros and cons of the two: 30-year DSCR loans right now are fixed, and they're a little bit better rates than your typical commercial loan at a small local bank. The commercial loans at small local banks can usually only go 25 to 30 years, and their interest rates are slightly higher right now. As the Feds lower their funding rate, that will come down, and it may be more appetizing to use a small local bank. But right now, that 30-year DSCR loans tend to take the cake. They're amortized over a longer period of time, which means your monthly payment is less, plus interest rates are a little bit less right now. Regardless of who you go with, build multiple relationships with small local banks and national DSCR lenders. Ask other investors in your area who they're using on the small local bank side as well as on the long-term side, and that will give you some vetted references that you can use. And then, as I mentioned earlier, you can use FasterFreedom Capital as well. We will do long-term 30-year DSCR loans. Our appraisals have been coming back great recently, and we're able to pass on super low rate terms with no markup. Check out the description, but also just go to FasterFreedomCapital.com to learn more. All right, now let's talk about the appraisal process. Hopefully you've learned a little bit more about what interest rates are, how they're calculated, and how to focus on them on this step. And once you pick someone that you go with, either on the small local bank side or the DSCR lender side, they are going to send out a third-party appraiser. That is someone that they are hiring that does not work for that lender, that is going to try to do their best to give a market value of the property. And naturally, you own the property, you want to get as high market value as possible because these lenders are going to give you 75 to 80% of what the property's worth. It's worth more, that 75 or 80% is worth more. For simple math, let's say you have $75,000 in a project and it appraises for $100,000. You are getting $75,000 or 75% of that from a small local bank or DSCR lender. Let's just stick with that 75% for now. Let's say that property, it's the same property appraised for $105,000 at 75%. You're now getting about $79,000 back, which hopefully is enough to pay your $75,000 plus interest. But what if it appraised for $110,000? $110,000 times 75% is $82,000 to $83,000. So the higher it appraises for, the higher check you're getting from the bank. Now, of course, you're going to have a little bit more of a monthly payment, but over 30 years or 25 years, just a little bit more is not going to change the game for you. But getting an extra $5,000 or $10,000 on the front end of the refinance will change the game for you. It will allow you to pocket that cash if you want it. It will also allow you to have more money to pay more people back and just give you more flexibility. Now, how do you maximize that? I have probably been on 40 to 50 appraisal visits when I was doing this for my companies back in the day. I would go meet the appraiser at the property. Every single time, without fail, I met the appraiser at the property. We got the appraisal that we needed or higher. The few times we have not met the appraiser at the property, we've usually got the number we wanted, but not always. And it's very, very important to get the number that you need or higher. I mean, if you logically think about it, it makes sense. The appraiser is putting their license or whatever on the line every time they appraise a property. They want to do a good job of it, so they tend to lean on the conservative side. They don't want to over appraise something. Who cares if they under appraise a little bit? They're playing it safe. However, they're not going to push that appraisal unless they have reason to push that appraisal. They may think this property is $100,000 to $105,000, maybe $110,000 property, this example we're using, but they're not going to put their butt on their line if they don't know you or know the details. They're just going to appraise it at 100 and move on. However, if you meet them, which I did and my team have done, you meet them at the property, you show them everything you did to the property, what it costs, you give them 3 legitimate comparable sales that show that this property is worth, in this case, $110,000, $115,000, and you respectfully say, here's the information. I did this for my purposes as I ran my numbers and kept track of my budget and showed what I have in the property. Here's why I need $105,000 to $110,000. Obviously, do your own due diligence, Mr. and Mrs. Appraiser. Here you go. I just want you to have that additional information. Have a great day. Let me know if you have any questions and leave. Just doing that will make a difference. The appraisal, again, will have that same thought process. This is easily worth 100, maybe 105, 110. These people told me they needed 110 to 105. I'll appraise it at 107.5 just because I'm not going out on too much of a limb here, but I'm giving them what they want because I met them. They seem nice, they're local, and they're not wrong on their numbers. You're not going to be able to go meet them and get $130,000 in this example, but you are able to push it by meeting them, putting a name to the face, a name to the LLC so that they see what you did and you actually show them that you care and everything you did to the property and why you think it's worth what it's worth. Again, they're going to run their own numbers, but at least give us some ammo and lets them meet you, and appraisers are people and there's flexibility, and they will most likely be a little bit more flexible if they met you. That may sound simple, but I promise that it works. If you appreciate that, hit that like button. If you have not, subscribe. Check out the other videos in this series. We're on video 4, so go back if you haven't. Go back to video 1 where I talk about the buy step, video 2 where I talk about the rehab, video 3 rent, and now the refinance method. And make sure to hang around and come back for the last video of the series where I talk about how to systemize this and grow this and really scale this to create financial freedom for you. I appreciate you for watching. Thanks for being here. Like, subscribe. I'll see you on the next one, and check out the description for more freebies.